This is the last video of our 4-part series on market internals or market sentiment. I explained to you that looking at technicals or fundamentals or price action or whatever you do to analyze the market is great, but market internals is like looking at an x-ray. When you're looking at a stock and you're looking at price, that's one thing, but market internals can give you a really good clue of what's really happening under the hood. So it's kind of like looking at a car and then looking at a hood, or looking at a person and then looking at an x-ray of a person. They can tell you different things. And I don't trade off of market sentiment, but I use it as a confirmation filter. So if I'm going to go long and price is telling me to go long, I'll use market sentiment to give me a good guideline of where to go long, where to go short, where not to go long, or just avoid the position. So the last factor that I look at, I've talked about volatility via the VIX. I talked about percentage of stocks making above the 50-day and the 200-day moving average in the S&P. We've talked about it. So let me talk about the last factor, and that's the bond market. So you may be saying to yourself, Roger, bonds are not inside of stocks. How is looking at bonds going to give us internals on stocks? Well, it's not. It's a mirror. It's a reflection, okay? Let me make it a little prettier there with an arrow. So it's a reflection mirror. So see, here's what a lot of traders don't understand. Stocks don't trade in a vacuum. The currency market is about 1,000 to 10,000 times bigger than the stock market. The bond market is about 150 to 200 times bigger than all the stock markets in the world. When you see economic data, when you see global events, it's not impacting the US stock market directly. It's impacting the bond market and the currency market directly, and the bond market indirectly, all right? The bottom line, the point I'm trying to make is this. The bond market isn't internal to the stock market, but it gives us a reflection of what we can expect from the stock market. Now, what do I mean by bond market? First of all, you could look at the long bond futures, the 10 or the 30-year futures, or you could look at the ETF, and you could look at an ETF. ETFs trade just like stocks. I'll give you the ticker symbol. It's TLT. TLT, that's the ticker symbol for the long-term bond. And don't get caught up in 10-year bond, 20-year bond, 30-year bond. Anything after 10 years, whether it's 10-year, 20-year, or 30-year, it has the same, the correlation will be 99.9%. So again, if you want to look at futures, you could look at futures, or you could just pull up on your stock ticker symbol, TLT, okay? It's that simple. Now, what do I look at bonds? I want to look at the bond market, and I want to see if it's trending, all right? If it's moving up, or if it's moving down, or if it's just moving sideways, all right? And I'm not talking about major analysis. I'm talking about a 30-day window. During the last 30 days, did the bond market move sideways, up, or down? If the stock market, if the bond market is moving down, okay, that means interest rates are going up. The bond market and the interest rate market are inverse correlated. So if bonds go up, interest rates go down. And if bonds go down, interest rates go up. So when you see the bond market moving higher, okay, that means interest rates are moving lower. That's bullish for the stock market, okay? If you see bonds moving down, that means interest rates are moving higher. That's bearish for the stock market. And if you see interest rates just doing nothing, bonds doing nothing and just moving sideways, that's neutral. So, what do? Don't enter the stock market. Don't enter the stock market when the bonds are trending lower, or lower your position, because that's telling us that traders are going to be going long interest rates, putting their money into interest rates and not into stocks, okay? When bonds are moving higher, all right, that means interest rates are moving lower, and that means traders are taking money out of fixed income and putting them in the stock market. And if bonds are neutral, we don't look at them at all. That means they have no impact at this time. So again, if bonds are moving lower, that means interest rates are moving higher, and that means you stay away from the stock market unless you want to go short. And if bonds are moving higher, that means interest rates are moving lower, and that means you want to go long. So bonds and interest rates are inverse. And when bonds go up, interest rates go down. When bonds go down, interest rates go up. If interest rates are going up, stocks are going to go down. If interest rates are going down, stocks are going to go up. And if interest rates and bonds are just going sideways, it has no impact. This is very general, but it'll keep you out of trouble when you're deciding whether to initiate a position, liquidate a position, or decide how many shares to buy. Because if bonds are neutral, if volatility is low, if very low percentage of stocks are above the 50-day moving average, market sentiment is steady, that means you can go into the water. It's safe to enter the water. And if that's not the case, then you may want to stay back and wait for market sentiment to get better. I hope this helped you. If you like these videos, please subscribe to our channel. I'll talk to you soon.